If you are a tax lawyer like me, then you probably struggle a bit with the concept of how to deal with deferred taxes in Pillar 2, not only in the year when the provision is made, but also in the year when it's reversed. So let's have a look at this at a very basic level. Let us start with loss-making companies. So we have a scenario, Exco makes 100 loss before tax in year 1 and 100 profit in year 2 before tax, and the tax rate is 15%. If we go to our journal entries, we debit cost of 100, whatever it is that we bought that we didn't manage to get sold, and we owe the bank 100 for what we bought, right? We've made a loss of 100, so in the future we will save 15 in tax. So we do have a deferred tax asset of 15, which runs through our P&L. So when we look at our P&L on the left-hand side, we have an EBITDA and we've got depreciation of minus 100, so we end up with an EBT of minus 100. We have zero current tax to pay, but we have a deferred tax asset of 15, so our net income or our financial accounting net income or loss is minus 85. And you look at our balance sheet, we start with a deferred tax asset, if we just take the assets first, of 15. Our bank is 100 in debt, right? And our equity was 100 of losses that we made minus the 15 in deferred tax asset that we got, so that is minus 85, and our balance sheet balances. What happens in our tax return in year 1? Now, normally when you make a tax return, you probably just start at the EBT, right? But to follow the GLOBE methodology a little bit, we'll pretend that we start at the final, like we do in GLOBE, and then we add back all the taxes. So we actually end up in the EBT in any case, right? So we have a loss of minus 100, that becomes our tax loss carry forward. We're not reversing anything, so I'm not booking anything in the tax loss carry forward row. And we have an EBT or a GLOBE of minus 100, and our current tax is 0. And the important thing here is whatever is the current tax in your tax return would be the current tax that you book in your commercial accounts. It is not what should be due or could be due or anything like that. It is simply what you book in your tax return. Maybe I'm oversimplifying things here, but that is the way my lawyer mind works. So what happens in your GLOBE return? We start with a final, which is minus 85. So we say we've got minus 85. We add back all the taxes to get to our GLOBE income, right? So that will be minus 15. And then we come to minus 100, which is our EBT, but it's also our GLOBE income for the year. And then you need to go and look at your adjusted covered taxes. There will be no current taxes to take into account, but you do have this deferred tax that ran through your P&L, and you would have to run it through your GLOBE calculation as well. So you will have minus 15 there. Now you won't really have a GLOBE effective tax rate of 15%. Let's just leave that at, as is. The most important thing here is that there are no top-up taxes for year 1. The other important thing to remember is that you do take the 15 in deferred tax asset in your GLOBE return in year 1. You can imagine a scenario where in year 1 commercially you think you're not going to ever make that 100 to earn back the 15 in tax, and you impair that 15, so you show no deferred tax asset. However, under the GLOBE rules, you always take the deferred tax asset or liability in the year in which the commercial reality happened. You do not take into consideration the subsequent impairments and reversals of those impairments. Now you come to year 2 and you make a profit of 100. So if we look at our journal entries first, we don't have, we've got bank because we sold for 100, right? And we've got income for 100. And now we, in theory, have to pay tax of 15. But if you look at our tax return, that'll have a tax loss carry forward of 100 and 0 tax due. So we also say we don't have any current tax, but we've got deferred tax from the previous year that we need to reverse. Just like in our tax returns, we reverse our tax loss carry forward. And that then will be a debit of 15 tax costs going through the P&L and a credit of 15 against your tax asset. And then if we look at the numbers here, we've got an EBITDA of 100, we've got an EBT of 100. We reverse our deferred tax asset because we had a plus 15 in the previous year, we'd have a minus 15 in this year. And we end up with a final of 85. If we look at our balance sheet, we had deferred tax asset that we've reversed, so that comes to 0. We had a tax loss of 85 that we have reversed, so that comes to 0. And we owed the bank 100, which we could pay back now through our sales, which is also 0. And it is as if nothing ever happened. And if we look at our tax return for year 2, we again do the thing of taking the final, adding back the tax. We end up with a profit of 100 or an EBT of 100. However, we do have a tax loss carry forward of minus 100. So our taxable income is 0, right? And we have no current tax due, which is also what we are reflecting in the financial accounts for year 2. There are no current taxes because the current taxes reflects what we have in our tax return. Looking at our globe return, the exact same thing happens. We've got a final of 85. We add back the tax of 15, so we end up with a globe income of 100. We have adjusted covered taxes, which consists of our deferred tax reversal, and that gets us to 15 as well, and our effective tax rate for the year is 15, and there is no additional top-up tax or top-up tax due on our positions. So to summarize, for our local tax return, we start with a final, we add back the taxes, we end up with the EBT, or we simply start with the EBT. We make any other book to tax adjustments like different depreciation periods and all that stuff. We calculate the current tax that we have to pay. We put the current tax into the financial accounts, right? Then we add any deferred tax effects from book to tax adjustments to the financial accounts. And then we have a deferred tax asset in this particular case because we will save taxes on future profits. And if you look at pillar 2, we start with a final, we add back all the tax, then we make the Article 3 adjustments, which is your income adjustments, so you can get to your globe income. Then we start with all the taxes in the P&L, and we make Article 4 adjustments, so we can get to the adjusted covered taxes. And then we simply calculate the effective tax rate by dividing the adjusted covered taxes by the globe income. Let us take another scenario. Now we assume we have an asset of 100 that we depreciate for tax purposes completely in year 1, but for commercial purposes we depreciate it over 2 years, right? So if we just go through our journal entries, let's say we had sales of 200, it goes straight to the bank. Then we've got assets, we buy the assets with 100 of the money that we now got from the bank, and we turn that into assets, so we've got 100. We depreciate our asset during the first year at 50. So we will run the 50 through the P&L and we will deduct it from the assets. And then we need to calculate the current tax due. Now, if we just go to our commercial P&L on the left-hand side, we have an EBITDA of 200. We deduct from that 50 in depreciation. So we end up with an EBT of 150. So now we need to calculate our current tax. And our current tax will be, let's just start with our EBT of 150. And then we have an additional depreciation of 50. So our EBT for tax purposes is 100. We're in a 15% regime, so our current tax will be 15, and we book that current tax into our commercial P&L. But we know that next year, commercially, we will still depreciate 50, but we won't be able to do so for tax purposes because we've already done that this year, right? So we need to bring in a deferred tax liability of 15% of 50, which is 7.5. So our final for the year is 127.5. And if we look at our balance sheet at year end, we started with a bank of 200, then we bought an asset for 100, so we have 100. And we started with assets of 100, but we depreciated that for 50, so we end up with 50. And our tax due is 15 as we calculated in our tax return, and there's a deferred tax liability of 15 as well. So our equity is the 200 in sales minus 15 depreciation, minus 15 in current tax, minus 7.5 in deferred tax. And then if we look at our pillar 2 return, we'll start with a final of 127.5. We'll add back all the taxes, being 22.5 together. We'll end up with a globe income of 150. We will then go and calculate our adjusted covered taxes, which would be our current tax, plus our deferred tax being 22.5. And our effective tax rate will be 15%, and there is no top-up tax due in year 1. Again, the deferred tax is taken into consideration regardless of whether for commercial purposes you impair it or not. It belongs to year 1 because that's when the action happened. So let us now go to year 2. And we'll assume that we had EBITDA again of 200. We will depreciate the remaining 50 of the assets. So we'll end up with an EBT of 150. And you can see the journal entries here on the right-hand side. Debit bank credit sales for 200. We're in year 2. And then debit depreciation, P&L, and credit assets, 50. And current tax, we need to go to our tax return for year 2. Now we'll just start again for convenience sake at the EBT, which is 150, equal to our final plus the add back the tax. We have an additional depreciation in the financial year, which we don't have in the tax year. So we need to add 50 to our EBT to come to a to come into a profit before tax for tax purposes of 200, and we will pay 15% tax on that, so that is 30. So we put the minus 30 into our current tax, but do we need to pay the full minus 30? No, because we have this deferred tax asset from year 1, or deferred tax liability that we now can release. So we add that back to our taxes, and then we end up in a financial year with 127.5. So let's just go through the commercial balance sheet to make sure we're all on the same page. We had in our bank 100 at the end of year 1. We made 200 in sales, so that is 300. We had assets in year 1 of 50. We depreciated 50, so we now have 0 assets. We had a tax due in year 1 of 15. We haven't paid any of that. We have another current tax liability of 30 in year 2, so we now owe the taxman 45. But we had this deferred tax liability, which we already provided for, which we now release into the P&L. So we've got 0 deferred taxes left. And if you look at our equity over the years, we started with 127.5. Then we added another 200 in sales. We deducted 50 for depreciation. We deducted 30 for tax to pay, but we had a existing tax liability, deferred tax liability of 7.5 already, so we can add that back. So then we end up with a total equity of 255 plus 45 gives you 300, and our balance sheet balances. And then if we look at our pillar 2, return in year 2, we start with a final of 127.5. We add back the tax of 22.5, so we end up with a globe income of 150. We need to look at what our adjusted covered taxes will be. It will be the current tax of minus 30 plus the reversal of the deferred tax liability. So we need to take that out. So it comes to 22.5, and 22.5 over 150 gives us 15% exactly. So no top-up tax is due upon the reversal of the deferred tax liability. And just to wrap it up, in our tax accounts, we start with a final, we add back the tax, so we come to the EBT, we make other books to tax adjustments, then we calculate the current tax on the above, we put that into the financial accounts, and we add all the deferred tax effects from the book to tax adjustments to the financial accounts, and then we get to our deferred tax liability. And for the globe income, we start with a final, we add back all the tax so we can get to the globe income. We make any other article 3 of the globe rules adjustments, that gives us the globe income. Then we calculate the taxes. We start with everything in the P&L minus 22.5. We make all article 4 adjustments. We calculate the adjusted covered taxes, which is 22.5, and we divide that by our globe income, which gives us 15% effective tax rate. Let us now look at a scenario where Exco makes a bad debt provision in year 1 of 100, which is not allowed for tax purposes, and then in year 2 the debtor goes bankrupt and Exco can take the tax right down. If we look at our commercial journal entries, we've got sales of 200, it goes to P&L, it goes to debtors. Then we provide for bad debt of 100 in the P&L, and we make a bad debt provision on the balance sheet for 100. So our current tax we need to go and calculate. Let's just do that. We'll ignore the final and add back. We'll simply start with that. We have an EBT of 100, but we got to add back the bad debt provision that we cannot do for tax purposes. So we end up with 200, yeah. And then our current tax on the 200 at 15% will be 30. So we'll put the current tax into the P&L, and we will also book here current tax of 30 in the P&L and 30 tax due in the balance sheet. But we do have a deferred tax asset if ever we get to take this right down, right? And that is for the 100 of the debtors, the bad debt provision. So we will book 15 as a deferred tax asset, and we will run that through the balance sheet as well. So our commercial P&L, EBITDA of 100, bad debt provision of 200, bad debt provision of minus 100, EBIT of 100, tax of 30, deferred tax asset of 15. So we end up with a final of 85, which is the right amount, right? And our balance sheet, we have debtors of 200 and we've got deferred tax of 15. We've got the bad debt provision of 100, which takes the debtors down to 100 effectively. We've got corporate tax due of 30, but we've got this deferred tax asset against that, which we cannot use now, but we can use it in the future. And our equity is the 200 in sales minus the 100 for the bad debt provision minus the 30 for the current tax, but we also have plus 15 for the deferred taxes. And again, as we said, we calculate your current tax and you run that through your P&L, but you first calculate the current tax in your mock tax return. If we look at what pillar 2 looks for year 1, we have a final of 85. We add back the tax of minus 30 plus 15, so it's 15. So we end up with a globe income of 100. That's our commercial income, right? And then we add back the 15 taxes, again, the combination of the deferred and the current taxes to calculate what our effective tax rate for year 1 is, and that is going to be 15%. Now in year 2, the debtor goes bankrupt and Exco can take the write down for tax, right? So we have an EBITDA of 200. It was against sales. We also book that debtors against sales, 200 to 200. And now we need to calculate our current taxes. So our EBT, if you want, in year 2 would be the 200, but we can deduct now the full 100 for the bad debts that we couldn't deduct in year 1. So our taxable income for year 2 from a tax return perspective is only 100 and the current tax due is 15. So we'll put the current tax into the commercial P&L, and you can see we do that here. But we also have a deferred tax asset that we can release against that 15, so we can take that into account as well. And then we end up with another minus 15 in the P&L because we had plus 15 in the P&L for year 1. When we formed the deferred tax asset, it was an income for us. We need to release that now, so we have an expense of minus 15, and that brings our final to 170. If we just look at our commercial balance sheet here at the bottom, we have debtors now of 300 because we started for 200 in year 1. And we had then we took this write down of minus 100, but we also made sales of plus 100, 200, so we end up at 300. 200 plus 200 minus 100. Our deferred tax is now 0 because we could deduct the 100 bad debts for tax purposes as well. Our provision of bad debts is 0 because we released it, and our corporate tax due is 30 for year 1 and 15 for year 2, which is 45. Over our total debtors, or our total income of 300, that leaves us now with an equity of 255, being an open equity of 85 plus 200 sales minus 15 for current taxes and minus 15 for the loss of a deferred tax asset or the reversal of a deferred tax asset. And if we now look at our pillar 2 return, we start with the final as always, 170. We had 30 in tax that we need to add back, so we actually had a low income of 200. But then if we look at our taxes, we've got 15 in current taxes and 15 in the reverse deferred tax assets, which adds up to 30. And 30 divided by 200 is 15%. So again, no top-up taxes due. And just to come to our comments again, as always, start with the final, add back the tax, gives you EBT. For your tax return, make any other book-to-tax adjustments like reversing bad debt. Then you can go and calculate what your current taxes are, like we did here, and then you add your deferred tax accounts from book-to-tax adjustments to your P&L, your commercial P&L, And then you have your deferred tax asset in this particular case, because you can take a deduction on the future write down of these receivables. And for pillar 2, you start with the final, you make your article 3 adjustments to your income to get to your globe income, then you start with your taxes and you make your article 4 adjustments to your adjusted current taxes and deferred taxes, and then you calculate your ETR. I hope that this has made things a little clearer for you. If you have questions or comments, or if you think that I missed something, please let me know. Again, lawyers talking about accounting, and especially deferred tax accounting, is dangerous. Talk with you next time. Bye for now.